Friday's labor report doesn't seem that bad on the surface, but take a closer look and you'll find that we are flirting with disaster. After revisions, June's non-farm payroll ended up negative for the first time since the sickness, the unemployment rate for new graduates topped 10%, and the Beige Book starts to actually acknowledge layoffs. This is the fundamental picture, but the technical picture is that the S&P 500 just notched a brand new all-time high, and the NASDAQ narrowly avoided a bearish trend reversal. The two stories seem at tension with one another, and they somewhat are, but remember, only price pays. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with just a little bit of an upper wick indicating some pullback from the all-time high, but nonetheless a candle close in the upper third of the weekly range is bullish. If we're thinking about location on the bar-to-bar count, notice that we do produce a lower low via the gap down on Tuesday, but we also get a higher high here. Now the candle close is the neutralizing data point because if you're a bull, you'd like to see a candle close outside of and above the previous week's range. We didn't get that. But if you're a bear, what you'd like to see is a lower high, and we also didn't really get that. So in terms of location on the bar-to-bar count, I would be a little bit more neutral here. If we're thinking about the overall weekly trend, of course it remains in the upward direction, and this is a brand new all-time high close on the weekly timescale, which would mean that if the weekly chart is going to pull back, we could still afford a higher low in the trend count from the highest high. I would still maintain the stance that a weekly higher low can be preserved over the previous all-time high here, which is roughly 613. If we take out the Fibonacci's coming in from this low up to the new all-time high, notice that the Fib 38.2 is no longer really confluence with the previous all-time high, however the 50% retracement is. If we bring out the Fibonacci from the low here, as we continue to make new highs, this Fib 38.2 will slowly creep up to become confluence with the previous all-time high. We're not there yet, but it's something to continue monitoring. If we come in here with the anchored view apps on the weekly timescale, you'll notice that we're above the entirety of the stack. If this gap down on the Tuesday morning session was going to be more detrimental, once again, you would have ideally seen a lower high on the bar-to-bar count or some sort of test and break of this anchored view app from the breakout bar back here. It simply didn't happen. If we come in here with the volume profile on the weekly timescale and zoom out so we can see the high volume nodes, what we'll see if we extrapolate out this node here is that we actually gapped into the high volume node, used it as support, and rallied to close out the week. In my view, this is bullish. The weekly timescale has not changed. Buyers are in control. And again, there's still plenty of room for a weekly higher low anywhere over the previous all-time high. Let's drop this down to the daily timescale and let's get a little bit more granular here. The first thing we'll evaluate is this week's expected move. If you're not familiar with the expected move, it is this gray box right here, and you can check out the video tutorial in the top right-hand corner on how to set that up. If we're contained by the upper bound, the number is at 655.94, implying a higher high and a brand new all-time high. If we're contained by the lower bound, the number is at 638.54, implying a very nuanced higher low. I would suggest that the expected move here is bullish for that reason. Obviously, on the Friday session, we made a brand new all-time high via the gap up. It was an intraday all-time high, so we do not have an overnight level to repair there. And that's the highest high now in the trend count, and therefore, on the daily time scale, we know that we can afford a pullback to set some kind of higher low. In a picture-perfect world, that ideal higher low is actually very close to the low of Friday's session, near the daily 20 SMA, and this level here at 642.20. The reason that's the key level is because it represents this previous set of lows from back here and the lows from this consolidation back here. If we're going to prevent all of this overhead supply from turning into overhead supply once again, we ideally don't want to fall back down underneath that level, once again, 642.20. Now, you can still make the argument that from here to here, the lower edge of the upcoming week's expected move is still technically a higher low. Obviously, if we just do something like that, it is clearly a higher low. The threat that would emerge if we actually make it all the way back down to that level, let's just say that price ends up doing this, is then a subsequent lower high underneath 642.20 potentially offers a lower high, and thus an equal low back down to this level at 634 would open the door for a trend reversal in the downward direction. I would not say that this is the primary base case, given that on the Friday session into the mid-afternoon, the buyers did step up off of our daily 20 SMA, and we achieved a fairly decent close considering the carnage from the morning sell-off. I would say this is roughly a 50% retracement to close in the midpoint midpoint of that Friday range, and most importantly, over a couple of key reference points. Again, the daily 20 didn't break, and we were also able to recapture this level here, the previous all-time highs, after a pretty substantial intraday overshoot underneath that 645.25. So the daily chart still maintains an uptrend. The candle structure on Friday isn't great because, of course, the picture-perfect outcome here would have been a gap fill reversal, staying over the highs of this session as well as the Thursday session at 649. You can see that we've still closed technically slightly below that level, which will set up intraday trades as we move forward into the coming week. So let's take a look at the hourly time scale, and let's get a little bit more granular here in terms of what some outcomes could potentially be. The primary thing to focus on is that the hourly trend remains in the upward direction. We have lows, higher lows. The low of the Friday session is technically a higher low, and I would also offer the idea that if we could stay over 645.25, it's another spot for a potential hourly higher low to continue the trend in the upward direction. So holds of 645.25 maintain the bullish base case. I would argue that I would get even more bullish on a sustained hold over the afternoon rally high, which is also the opening print from the Friday session of 2 weeks ago now. That's going to be at 647.50. Then the bullish trade to actually take is just a Brigade bolt over 649, targeting the all-time high. That is one situation to trade where your risk-reward profile might look something along these lines here. If we're consolidating and we dip below and then come back above for a higher low, you could even attempt the long for some sort of risk-reward profile that looks like this, and then balloon runners towards that all-time high, noting that you would attempt some kind of trade pathing that looks like this on top of those risk-reward ranges. The time where I would become a little bit more neutral is on a failure underneath 645.25. I would start being open-minded for tests for that daily higher low up against 642.20. That would be the ideal place for that, remembering that what we talked about here, previous lows that held, as well as these lows from this balance back here, previous lows that held. We really don't want to fall back down underneath that level, 642.20. So again, your bearish to slightly neutral outcome might be consolidation here that yields a lower high under 645.25, still has the opportunity for buyers to step up here, and where I would really change my tone back to bullish, if you would like, you could technically try the long here, but this would be the incremental higher low on the hourly chart, right? Because this is an hourly downtrend. Let's say we have highs, lower high consolidation. If we break here, this technically brings in a lower low. That would solidify the daily higher low as a firm higher low, not a soft higher low. Remember, for a daily higher low to be firm, we need the hourly trend to flip to down. We can accomplish that via some sort of lower high here and a lower low happening at 642.20. We don't want the hourly trend to remain down. The reversal of the hourly trend from low to then hourly, let's label this 1 hour, higher low here back over 645.25 would instill confidence, and I would imagine that over time we're trying to navigate back towards the all-time high, continuing the daily trend in the upward direction. So that's really what I would say is the base case as we head forward into this week's worth of trade. Obviously, if there is no consolidation first, if the market just rips right over 649, this is also a logical trade. And then, and part of that reason is just that we have thin structure here, of course. And then beyond the all-time high, of course, you're really just looking at blue sky territories, $1.50, upper edge of the weekly expected move. That's the way I would trade that going forward. Where I would start to become a little bit more cautious, as we know and talked about on the daily time scale, is a failure to hold at 642.20. So say a big opening drive early in the week produces a lower high here. That's what we talked about, where, okay, technically speaking, if you want to split hairs with me, this would hypothetically be a daily higher low still at 638.15. But this lower high would definitely be a major threat that I would watch out for, noting once again just the amount of overhead supply that we would have off of a very visual level here on the technical charts, and once again a failure of our daily 20 SMA. Let's come in here with some Fibonacci's on the smaller time frames. Let's start from the low here up to the high. Notice that your Fib 38.2 is spot on the money with that key consolidation phase we were just talking about at 645.25, and the Fib 61.8 is spot on the money with our big line in the sand, or the ideal daily higher low at 642.20, reinforcing both of those key levels. I do just want to see if my eyeballs are on point, so to speak, with the 50% retracement into Friday's close. Not bad. Not bad. If we take a fib from Friday's high to the low, we did retrace about 50% of that move as we were eyeballing on the daily. Let's come in here with our intraday anchored VWAPs and see what we can see from this perspective. I find this quite compelling. If you take a look at the anchored VWAP from that Friday session, we actually closed over the anchored VWAP. So therefore, anyone who sold short on average from Friday is technically underwater. You'll notice that the cluster of anchored VWAPs underneath us will slowly start to lift the more time we spend over 645.25, providing some sort of support here. around 645.25, meaning that consolidation, likely being supported by anchored VWAPs, should yield some kind of upside price action that looks like this for one of those base cases we had already described over 649, ultimately for thin structure retracement to retarget the all-time high. Let's come in here with our market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. What do we see? Do we have stronger sellers stepping up? And primarily what we care about is actually analyzing the morning breakdown of that Friday session. Do we see stronger sellers getting active at the exchange level? Volume flows on Friday say absolutely not. Advanced decline line says absolutely not. Although it fell out of trend higher zone, right? It moved towards the zero line. It never went negative. Even the index score intraday never really printed a sustained negative build down towards negative 15, negative double digits, negative 20. It wasn't the case whatsoever. So really, it's more like liquidation break at the all-time high than anything more severe. If you look at the cumulative build out of the tick, it actually closes positive. So at the exchange level, again, if we just go back to that core question, do we have stronger new money sellers stepping up on the gap up from the Friday session? The answer to me is absolutely not. What about the market profile? Do we see any nuances here from the profile that we should pay attention to? Of course. With that B-shaped profile here from the Friday session, this is your lowercase b look, I would say that that is indicative of long liquidation off the highs. This is not new money sellers. Notice how emotional this was as we just sort of had this thin structure breakdown to really balance back off inside of the Thursday range. Notice that the value area is completely contained and inside of Thursday's range here. The point of control does shift lower with price, but it's not like we had this slow methodical grind to the downside all day where new money sellers were just sitting waiting for VWAP, tagging it, offering prices lower, so on and so forth. It was not one of those days where we had a big drawn out trend. It was just liquidation break from longs who were potentially long late to the party. What you'll remember is that on Thursday, we actually had a point of control shift right up into the spike of that end of day session. So hypothetically, if you're a stronger buyer, what do you want to see? You really don't want your position offsides into the close of Thursday, so the base of the spike should have acted as support. Clearly there was nothing there and the consolidation exists underneath. That is a emotionally driven trigger for these longs late to the party to close out, which is likely why you saw that sustained downside through that morning breakdown, right? In terms of the amount of momentum that was there and just the boom, 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 boom. It was just sell, 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 sell immediately out of the gates, right? Because these longs were positioned quite poorly. So with that going forward, I would say these B period single prints and A period single prints above, any sort of move early in the week over the value area from Friday, something that's over, sort of your 64.93s in the ES futures should bring in that thin structure retracement. Now, lo and behold, what does that coincide with? Over on the Spiders Cash ETF, that's some sort of hold over 647.50 and then the subsequent Brigade bolt over 649. So this would align with keeping that value underneath us from Friday and getting lift in the upward direction, right? Now that longs have a better location, if they're going to sustain price, we want to make sure that we move away from value in the upward direction via what we just talked about. Let's jump on over to the NASDAQ side of the marketplace here and see what's going on with the NASDAQ. So, of course, that's what we're going to do when we drift over to the NASDAQ. We're going to see what's going on with the NASDAQ. Here we go, weekly time scale. Thanks for bearing with me as we adjust some charts. As always, what do we see? Candle structure and location. Well, candle structure is very similar to the S&P 500. Solid green body bar, just a little bit of an upper wick. Nonetheless, a strong close in the upper third of the range here. You get the same thing in terms of location, lower low, as well as a higher high, and a close back inside of the previous week's range. What you'll notice, though, is that we were unable to produce a brand new all-time high here. I would really start thinking of this as a consolidation on the weekly timescale for the NASDAQ. Now, thinking of the overall trend, of course, it remains in the upward direction, and even though we're consolidating here, there's really no threat for a trend reversal yet. Just like the ES or the S&P 500, I would still expect that if the daily trend ultimately does flip to down, and to do that, we know that we need to break the neckline of what is a head and shoulders, that would be roughly in here. There's still the opportunity, this is where the daily trend flips to down. I would say that the weekly higher low can still exist over the previous all-time high, very similar to the S&P 500. So no issues with that. Now, obviously, if this is bull flag consolidation, because let's not forget, the trend is obviously up, this is consolidation on the higher time frames. If we break out through these highs, one thing I think we should start looking at is the potential for a flag breakout measured move. Coming from here to the pullback low, Let's see what we're working with. I mean, I'm not talking about 640 in the coming weeks worth of trade, or never mind even the next 2 or 3 weeks worth of trade, but over time, something like 640 could be a measured move target if we get a flag breakout into blue sky territory, something to carry forward as we move into the next couple of months, I should say, worth of trade. Let's come in here with a Fibonacci just to check in on our Fib 38.2. Again, creeping up slightly above the previous all-time high if we come in from the low, just to double check on this one, slowly working its way up for confluence at this level. What about the NASDAQ anchored VWAPs on the weekly time scale? Nice gap into the anchored VWAP here. Once again, if you're a stronger seller, what you'd like to see is a gap fill reversal underneath the prior week's lows, keeping pressure on that anchored VWAP and potentially closing the weekly bar underneath. And it simply didn't happen here on the higher time frame, so can't really be bearish on the NASDAQ weekly. Let's take a look at the volume profile and see what we're working with in terms of high volume nodes, doing something that looks like this, extending that out to the right. We closed right at it for all intents and purposes, and once again, if we were to break over these highs, we do have a new all-time high breakout. It's blue sky territories above. So just like the S&P, very difficult to become a bear on the higher time frame. Let's go to the NASDAQ daily chart. Let's firstly evaluate this week's expected move as we typically do. What do we see here? So gray box, upper edge of the expected move right around 585.96. Brand new all-time high, higher high in the trend count. If we're contained by the lower bound, we have 566, something in there, 566.30s. Let's say, give or take, right around this small gap range from the Tuesday into Wednesday session. That is also going to represent a potential higher low on the daily timescale. What's most important about the NASDAQ is, as we said, the avoidance of the possible bearish trend reversal. Everybody and their brother's, mother's, aunt's, goldfish, second removed cousin could see the head and shoulders pattern. Again, nobody's special for calling this out. It's about how you actually execute around the pattern. And here at the Trade Brigade, as we always say, you don't front run the pattern. You need to wait for a potential lower low to actually trigger this, and lo and behold, we never actually brought in that lower low. We held 560.25, and as you can see, we actually broke out on the Friday gap up over the right shoulder of the pattern, invalidating the head and shoulders at this point. So as we walk forward, now we have a new higher high in the trend count. We are seeking a higher low on the NASDAQ daily. And as mentioned, the lower edge of the weekly expected move would be a fine place for that. We have our daily 50 SMA potentially providing confluence at that level. I personally would like to see the NASDAQ not make it any lower than this 569 for many similar reasons to the S&P 500. If this is potentially something that we could use as overhead supply should we break back down below it, I want to avoid the possibility of a lower high underneath. Now, of course, it doesn't matter what I want. We'll trade the outcome that the chart ultimately ends up sort of showing us. But in a picture-perfect world, the higher low would stay above that. Thus, all the buyers in the box are still somewhat content with their long positions, and then we could seek the higher low over 569. So that would be the more important level that I would watch as we move forward into the coming weeks worth of trade. The best spot would just be not moving into that range whatsoever. I think it's a little bit optimistic here, but that's going to be at 573.85. If consolidation exists above that box and we rally, of course, the all-time high just ends up being the target at 582.80. So the trend here is working its way back in the upward direction. I think, again, the main takeaway from the NASDAQ daily is this higher high invalidates the opportunity for the head and shoulders that everybody was watching out for. Again, if we bring in some kind of lower low underneath 560.25, I will change my tone if the chart does something that looks like this. But given the structure and the sequence of where we are in the trend, first thought is that higher lows persisting over 569, higher lows over the daily 50 and this 566 30, 50-ish area in here, lower edge of the weekly expected move, gap fill reversal, will maintain a higher low in the daily trend count from here to here, meaning we have a daily uptrend. If we just get consolidation or any kind of holds over, let's say that on Monday we open over 576.50s, how could you not be bulls on parade? At a certain point, right, you're going to have to change the narrative to, okay, instead, this is a double bottom. We're over the neckline, and we should be very much so bullish here, seeking this continuation into blue sky territories. Right? So those are your key price points on the NASDAQ daily. Let's take a look at the hourly time scale and see what else we can learn here. Let's bring out the Fibonacci's first from the lows up to the highs. Does this align with what we've been talking about? I think survey says yes. 68.1 line in the sand from a fib perspective, on par with 569. It's kind of in between here. It's a little bit of an overshoot to the downside, but I think it suggests the similar sort of outcome. Staying above that would be the ideal. You can see also the fib 38.2 loosely aligned with this level here at 573.85 that we've already identified, and we can quickly come in with our anchored VWAPs, and then we'll give you the bottom line pathing here on the intraday. We closed over the Friday anchored VWAP. These are going to be inside of the balance range between about 573.85 and 569. Not much help from these until over time, perhaps, if we continue to spend time above here, they play catch up with 573.85, offering confluence at the top end of that balance range. So your bottom line pathing here out of the NASDAQ is going to be in here, I would be somewhat neutral. Back over 576.50, I would be bullish, targeting the high of the Friday session. It's going to be at 581.25 and then the all-time high. If we open over 576.50, pullback longs off of that level become attractive to target the same spots, high of Friday and then the all-time high. If there's just an opening drive, that might become difficult to trade intraday, but any consolidation up here or Brigade bolts into blue sky territories, chart speaks for itself, whole and half dollars, intraday level set form. If we do get some sort of breakdown underneath, let's say we open here and Brigade bolt underneath 573.85, you could hypothetically trade some shorts from point A, let's call it, to point B, but I would not overstay my welcome at point B, 569. I would certainly be looking for the daily trend reversal, something that would be like this, right? So consolidation, Brigade bolt here, and then if this is going to be your daily high or low, that's where you would build confidence. I would be seeking longs at this level rather than being short into that 569. All right, that is the QQQ on the hourly. Let's take a look at the NASDAQ side of the market internals and see what's going on from this point of view. Similar questions that we'll ask relative to the S&P 500. Do we have new money sellers stepping up at the exchange level on Friday? Survey says no out of volume flows. Survey says no out of advanced decline line. A little bit more of a mild build out of the cumulative tick. It's much more neutral than anything else. But the bottom line here is, once again, is it worth changing tone to being an aggressive bear on the labor report? And oh my goodness, it's the end of the world. Not really. We're not seeing it in the underlying data here. When and if price starts breaking down and reversing trends on daily charts, reversing trends on weekly charts, I'll be much more concerned. And I know the monthly bars just closed literally last week and we went through the monthly exercise, but when higher timeframes change with the narrative on the fundamental side that is also bearish, then I will sort of wave the white flag and become very cautious of our daily charts and what we're doing in terms of the bullish narrative. But as of right now, we're just not seeing that deterioration on the higher timeframes in terms of where price actually is settling out. Let's go on over to the market profile of the NASDAQ to finish up this side of the marketplace. Way zoomed in over here. What the heck is going on? Let's see if we can reset that. There we go. B-shaped profile, very similar to the ES. I don't have any updated commentary on the NASDAQ market profile. Good excess on the lows, good excess on the highs. Single prints in the A and B prints there. Value back inside of that Thursday session. The only thing I'll say here is that on the NASDAQ, the value area on Thursday did not drift up here towards the spike, and instead value is actually overlapping to up on that Friday session. Once again, a little bit more of a bullish data point here on the NASDAQ side of things. So very, very difficult to maintain an overly bearish stance given what I'm seeing here from the data. Let's jump back on over to the platform and take a look through the last index, the IWM Russell 2000 and the small caps. Let's go weekly chart to start. Let's go clean drawing set and we'll see what we can see. In terms of candle structure and location, a little bit different than the S&P and the NASDAQ, noting, candle structure, I'll give it similar there, but notice we have a much more mild gap down there. It is technically a lower low. We do have the higher high, but notice that we have a candle close outside of and above the previous week's range. So a little bit more bullish here on the small caps, and likely just on the premise that lower rates are right around the corner, given the deterioration in the labor market, which we'll talk more about in just a second. In terms of trend, obviously this is a brand new, not all-time high, but higher high in the trend count. This is the last higher low. I would still maintain the stance that any kind of higher lows over this top end of the balance range on the weekly would preserve the trend in the upward direction. That's roughly 225. We can come in here with a couple of Fibonacci perspectives. There's many more to view on the small caps. Notice that this, well above the Fib 38.2, we can come in from this low to this high. The 50% retracement is now spot on the money with the top of the prior balance range. And the final Fib perspective is really coming in from the all-time high to the low, just continuing to reinforce that we're well over the Fib 61.8, dramatically increasing the odds that we should get a full 100% retracement, aka new all-time highs in small caps sooner rather than later. Let's clear this up. Let's take a look at our anchored VWAPs on the weekly. Above the entirety of the stack, probably worth bumping one out to this low set in here. Let's go 728 on, I don't know, let's take, we don't want the previous all-time high, but maybe this one here. Let's go 728 on this together. Let's go 2025-07-28. And let's hit OK on that. So well above this, and lo and behold, just like we did last week, basically, confluence with the top end of the balance range there. Once again, that's 225, give or take, on the IWM weekly. Let's drop this thing down to the daily time scale. for small caps and evaluate our expected move, the whole 9 yards, as we typically do. Expected move is going to be bullish. Obviously, it's in this gray box right here. You should know that by now. We've got the upper edge at 243.13, higher high in the trend count, and we've got an equal low in the trend count at 232.41. I would still be bullish here, noting that the daily trend is clearly up. This is a brand new higher high in the trend count. On that Friday session, we have lows, higher lows, higher lows. I've still been a proponent, because this is very difficult to consider an hourly downtrend here via the gap down on Tuesday. I've still been a proponent that the daily can produce a higher low over 228.65. Probably don't want to see it go all the way there at this point, given that we broke out on the Friday session, but if it were to go there, I would still give the small caps the benefit of the doubt at 228.65. I guess my main thing there would be, I wouldn't call it a bearish breakdown, but I would be a little bit, how do we weigh the data points? If we were to see something that looks like this, I would still give the bulls the benefit of the doubt, and I would only really change my tone to bearish if we cleanly set a lower high and had the equal low already on par, right, on tap. Something like that was being produced, fine, I'll change my tone then, but I'm not changing my tone on the first test of that 228.65. So hopefully, through walking through that hypothetical example, gives you a little bit more color as to how I'm thinking about this. If we do just consolidate over the top end of the flag, it's as simple as calling it a bull flag, and let's see if we can get this move up towards the all-time high. Falling into the flag, consolidation. Maybe in the short term, you get a little bit of head and shoulders look. Maybe there's a scalp from point A to point B, but again, I would not overstay my welcome at point B, 228.65. Let's see it on the hourly chart. Very clean gap up on the morning session, rally, fade, and then closes back above 237. So if you're a stronger seller, what would you have ideally liked to see? Let's completely fail the breakout. Let's produce this lower high, and let's not rally into the close. Let's actually sell off into the close. It simply didn't happen, and this to me is a bullish tailwind for the S&P 500 as an overall data point ultimately. So 237 is the top watch early on in the week. If we're consolidating above, bulls in control looking for upside. If we drift back down underneath, maybe short-term bearish, maybe some intraday action that would provide a pullback in the S&P 500, but really not changing my tone overall to becoming bearish in small caps until we break down underneath something like 228.65. Let's quickly pull out the Fibonacci's from a couple of points of view. Come in from this low, that's the Jackson Hole low, up to the highs. You can see that the Fib 38.2, spot on the money after the pullback and rally from here. That's all set. 68.1, spot on the money with the key level there. Let's come in from the low here up to this new high, and you can see very similarly, 38.2 is right on that 237. So all things considered, not a bad look with confluence. Let's come in with the intraday anchored VWAPs, and you'll see that we did close over the Friday anchored VWAP, and these will slowly provide confluence at 235.15. And therefore, even if we do pull back, let's just say that hypothetically we do get this, it might not even make sense to get short there on the possible look above and fail until you're actually underneath 235.15. Like if we break that, then fine, we're breaking the anchored VWAP cluster as well. Maybe we get the downside rotation, but on the first attempt, I wouldn't necessarily be bearish underneath 237, but on a hold of 235.15. Let's jump into our Russell side of the market internals and see what else we can learn from this point of view. No stronger sellers here via the pullback after the gap up. Decent sort of neutralization out of the advanced decline line. A little bit more bearish on the cumulative build from the tick, but not all that bad, noting that your substantial read is like 2,000 plus out of the tick. Just didn't happen into the close. It was literally negative 50. Hardly, 'tis but a surface wound, right? So there you have it out of the Russell internals. Let's take a look at the Russell market profile. Looks like we'll have to do another rezoom over here too. What do we have out of value area, point of control, the whole 9 yards? Obviously, we are continuing to drift in the upward direction. You could see that we definitely overshot the spike of the Thursday session, but notice that the point of control on Friday did still close higher in the midpoint of the Friday session, but higher from that Thursday point of control. A little bit of lack of material excess. Let's zoom in on that a little bit. How many TPOs do we have there? Yeah, between like 4 and 5 perhaps. Okay, it's actually fine. That's fine. Plenty of excess on the lows of that Friday session. Value again overlapping to up, decent excess in the A period highs. Really no major structural deficiencies I would be too concerned with in the Russell here. Over value area high would just continue to retarget the Friday high here. Let's get back on over to the platform. Let's take a look through our sectors and see what's going on from that point of view. Do we have risk on? Do we have risk off? How is the rotation? Let's filter this by weekly performance. There we go. Let's see what we've got. Who is leading? Who is losing? Where was the weight? Communications up 4.31% on the week thanks to Google and the massive gap up there. We've got semiconductors just behind, up 3.6%. The bond market, really big gap up on Friday, up 3.42%. Not a sector. Then we see discretionary and tech definitely outperforming the S&P as well by about 50 basis points minimum on that tech sector. At the bottom end of the barrel, it's going to be the energy sector, the financial sector, utilities, and consumer staples. So I don't know about you, but this is still looking like a risk on rotation as the market is breaking to that brand new all-time high on that Friday session. Now, granted, the market did fade there on Friday, so let's take a look at the daily performance and see what was going on. So real estate outperforming healthcare, bond market, communications still did quite well, materials, staples. Then at the bottom end of the barrel, it's financials, energy, tech, semiconductors are down there as well. This makes sense considering that a majority of those semiconductor names did pull back in sort of sympathy to the Broadcom pullback from the new gap up as well. We'll get into that. I think the larger story is just the pullback that we're seeing in financials. It's kind of like money was rotating into financials, and now all of a sudden it's just kind of like, we're stagnant. We don't know if we really want to be in financials anymore. So let's get into the structural charts and talk about this story a little bit more. Really not much to say about real estate. It's been stuck in this range. I think when and if the shoe drops for the rate cut in September, it's not this week. In terms of the FOMC, it's the 17th. That's the following week. We might see an uptick here out of real estate, just noting that prices will likely increase as mortgage rates come down to some degree. If we look at healthcare, I think that this is also not really a story to report on until we break out of this range here. I think it's noteworthy that we aren't just ping-ponging from the top directly to the bottom of the range. And as we'll see in a trade idea, we're still watching UNH basically. If we get over 138.75, it would just be upward pressure for the S&P, but it is a defensive sector. Let's jump into the bond market here. You can see the massive move higher on that Friday morning session. This is on the premise that the Fed is likely going to have to cut rates in response to the deteriorating labor situation, which we'll talk more about in just a moment. But over the daily 200, and more importantly, breaking out of this range in here at 88.25. If this is going to continue in the upward direction, there's really nothing stopping it until we move up towards about 90.10. Let's jump into communications again, thanks to Google and everything going on there. Just huge outperformance on the week. This is bullish. It's a heavier weight risk on sector. It's top 4. But it's not quite as prominent as your XLK per se. Nonetheless, still bullish, still risk on here. New all-time highs. As long as there's a higher low over the previous all-time high, no problems on pullbacks. Let's take a look at materials. No breakout yet, but still watching this 92.70 spot. I would think with lower rates, this could see the prospect of a break there, which would be bullish for the S&P, but it's the lightest weight sector of them all. Let's jump into consumer staples. Watching this 80 mark quite closely. What I think will start to become a little bit more of a story is whether or not consumer staples start sliding aggressively as a story literally about consumers. And if consumers can basically afford to continue living, or if we start to put the pressure on in terms of that nasty R word, recession, as a story. Okay, so it's going to really revolve around layoffs. We're not quite there yet, but anecdotally things are starting to get a little bit closer to a tipping point. Let's jump into financials. You can see that we've pulled back pretty aggressively on that Friday session. Big bearish engulfer here, completely wiping out what I would have considered the picture perfect hold of the previous all-time high test on that earlier week Tuesday session, even Wednesday as well. No dice on the hold there via Friday's close. So I would watch this very closely. If financials start to struggle underneath 53.25, I think it offers a little bit more of a struggle point in the S&P 500, remembering that this is the second heaviest weight sector by market cap. Now, if on Monday morning this thing immediately rebounds off the daily 20 and the daily 50, gets back over 53.25, then big sigh of relief. Fine, bullish consolidation persists here, and over time, this will be your next big bull tailwind for the S&P over 54.10. So watching that very closely. Financials will tell an interesting story this week. Energy, not much to talk about over here inside the balance range after a failed breakout. The tech sector avoiding the neckline breakdown, as we talked about with the QQQ. The difference here, of course, is just that you did not take out the neckline of this as a double bottom yet. So watching 266.65 very closely this week. If we can get above, bullish the S&P. If we can't, I'd remain somewhat neutral in here until that ultimately takes shape. Let's move along to semiconductors, very similar to the XLK, of course. No breakdown of the neckline, and instead just kind of neutralizing around this right shoulder mark. Once again, it was unable to take out what could be considered the double bottom neckline here. The more time we spend over 293.15, the better for the SMH. If we start to spend more time underneath, I would be somewhat concerned that still over time the pattern remains in play. But as a mantra here on the channel, remember, it's not a head and shoulders until it is. You need to break the lows, you need to bring in a lower low, and then we will change our tone for the full trend reversal. Until that happens, it's neutral. Right? So watching that very closely, 293.15 and the trigger point at 283.20. Let's jump into utilities. Not much of a story here, just pulling back to the prior highs. If it can support, fine, small bullish pressure for the market. If we take a look at the discretionary sector here. There we go. Great looking breakout, right? Obviously on that, Friday move to the upside. Elon Musk's pay package pressuring the index or the sector higher here. Over 234 looks fine. Higher lows are still on tap. I would say even here at 232. As long as we're above that, mild pullback in the context of an uptrend, seeking all-time highs as a major target over the course of time here. Where would I change my tone to being more concerned? Probably underneath 227 on the XLY if we're taking out this previous low that was set in the trend count. Moving along to industrials, not much of a story here. Sideways in the balance range, just like the SMH. It's not a, in this case, double top until it actually is, which would require a breakdown under 148.25. Big lower wick on Friday, more neutral than anything else in the midpoint of the range. Let's take a look at some ratios now and see if this is supporting the idea that we're still in a risk-on environment. If you're not familiar with sector ratios or how to set up ratio charts in Thinkorswim, check out the video tutorial in the top right-hand corner. What do we see in the top 4? These are the heaviest weight risk-on sectors. XLC, as we know, looks phenomenal. XLF, this is not really the look that we wanted to see, rolling over underneath a downward sloping 50 SMA as the second heaviest weight risk-on sector. So this would be a little bit of a white flag, just persisting the downtrend, unable to really change the trend in the upward direction. The next big watch here would be if this can turn around for a higher low and pressure the equal high, then fine. If it can't and we make it down to the equal low, that would continue to be a white flag, probably turning into a red flag. XLK continues to underperform. We know that this has been the case for the last couple of weeks. So it's very difficult to say that we have like a raging bull market. Oh my God, you know, it's just like all signs are pointing to risk on. I would say that this is kind of neutral here. You're really just dealing with discretionary and communications fueling the rally higher. Now, on the flip side of the coin, you can't really say that we have a defensive risk off rally here because you're not getting healthcare outperforming. You're not seeing staples outperform, and you're certainly not seeing utilities outperform. So I don't think it's defensive. I don't think it's bearish based on posture, right? So it's like we're still risk on, but it's just not firing on all cylinders. If we take a look at the AB sets here, you can still see, again, neutral but still risk on, neutral but still risk on, neutral but still risk on. You get the gist. This is just straight up risk on in general, staples versus discretionary. This is still kind of okay, but still likely leans more risk on, upward sloping 50 SMA, flattening out a little bit here, but trend is generally up on higher time frames. This as well, I would say, is just kind of neutral in this box. If we start making aggressive new lows, I'd be concerned out of some of these charts, but we're just not seeing that. Let's jump into our B set and see what else is going on here. The gold ratio is sort of signaling, and maybe this was an advanced warning shot across the bow with what's going on with the labor situation, but gold breaking out there is a little bit of a defensive posture. However, this is one data point that we are looking at thus far. We've seen one data point here out of the many so far that suggests, okay, let's maybe take it easy a little bit. So, you know, if you're a bear out there and you're latching on to this narrative that, oh my God, gold is breaking out, it's sending a huge warning shot, you know, through the market and nobody's paying attention. It's like, no, you're the one not paying attention because you're putting all of your eggs in one basket and not collectively looking at what the market's doing, right? So that's my take on gold. We'll acknowledge that this is not really a great look for risk on, but it's only one data point thus far. I would still maintain the bullish stance for risk appetite, basically, and the lack of flight to safety, noting that the TLT ratio, yes, outperformance on Friday, but still underneath a downward sloping 50 SMA. If that changes, we'll change our tone, and then maybe we have two bearish data points, but we're just not there yet. If we move into Bitcoin, I want to go to a full screen chart of Bitcoin here, just so we can see it. The double top is still absolutely in play, and as of the rally, the counter trend through the week, we've been unable to recapture 113,850, so this is another small bearish data point for a risk asset, or as a risk asset. It's not really aligning with the story that, hey, everything's fine and dandy. So I don't think everything's fine and dandy. It's not as strong as it once was, but it's also not like sell everything and duck and cover underneath your desk and, stick your thumb in your mouth and start praying, I don't know, to the market gods that it's not going to be that bad. Like, let's chill out from the Armageddon storyline. It's not at that point yet. So Bitcoin here, obviously relative strength over on Ethereum. Let's go ETH on this. You can see that we're still over this 4060. Ignore the lower study now. That's not really applicable to this. But consolidation here is actually just bullish on Ethereum. So Bitcoin's breaking down, yes, but Ethereum has great relative strength, and it probably turns into a relative strength trade if Bitcoin straightens itself back out over the neckline. I would want to be long Ethereum on the break, not so much Bitcoin. So watching for something like that, and that would be a risk on indication if it takes place. Let's jump on into interest rates and the dollar, obviously falling off of a cliff via the move lower on Friday, via the weaker than anticipated labor report there, primarily in the revisions. If you look at the dollar, also sympathizing with those lower rates, moving slightly lower. Let's jump into, I want to look at the gold chart in isolation here, not just the ratio. Let's bring this down a little bit. Oh no, Thinkorswim's going to break on me now. See this little glitch? See the blue line right here? It's going to be glitched now. I can promise you that. So gold breaking out, I think that it's a pullback along anywhere over 35.32. You can see the ratio chart is still maintaining that upward look we just saw. As long as pullbacks hold that, again, I think that gold as a trade is fine. Longs over 35.32s. Let's see if it wants to play nicely. I don't think it will, but I do have a solution in my back pocket. Inverted ZT, and of course it's broken. So what we can do is we can detach, and I will show you this inside of this smaller grid now, which is just so funny how Thinkorswim operates like that. Inverted ZT, rolling over to the downside, prospect of Fed rate cuts likely increase there. It's not really a shocker. I'm going to close that up for the time being, and then we'll jump into our Fed Watch tool. You can see here that the odds have shifted substantially. We've got 89.0% odds of a cut, at least a 25 basis point cut. And you might be thinking, well, wait, I thought it was higher than that on Friday ahead of the labor report. And you would be correct. It was like 97% odds, and then 3% odds or something of the sorts were for a pause. You'll notice that now there's 11% odds for a jumbo cut 50 basis points in September. So this is actually even more dovish than we were prior to the labor report. As we look through some of the data points that came out here, the ADP non-farm was the first warning sign at 54,000 versus the 73,000 expected. You could say JOLTS was as well, coming in pretty light here at 7.1 versus the 7.38 expected. But really what I think the market's keying into is the non-farm and the revisions that exist through, as we mentioned in the intro, the June time frame, right? If we just go over to June, you can see here it's that small little red data point. That's the first negative print since, oh my goodness, the economy's shutting down, right? So you could just see the precipitous drop in hiring here, which is going to make the beverage curve potentially indicate that a spike in unemployment could be, I don't want to say somewhat imminent, and I certainly don't want to be rooting for a massive spike in unemployment, but the weaker the addition to payrolls, obviously, the more susceptible a big, sort of mass layoff or the more impactful a mass layoff would potentially be. If we take a look at the unemployment rate, and I know I showed this graphic in the intro, but your unemployment rate of new graduates is like topping 10%. It's a pretty big move there over the last couple of months, indicating the near impossibilities for new grads to get jobs there. So not really an environment where you have the new and young workforce coming into the labor market and promptly adding themselves and producing productivity. In terms of the prime age, you certainly see stagnation in the unemployment rate, and the upper edge of the cohort, they're sort of stagnating as well. Not much to really talk about on that front. If we look at the beige book, what I really want to point out is the talk of layoffs. Where is it? Right here. 2 districts reported an increase in layoffs. This is from the beige book that was released on Tuesday afternoon, Wednesday afternoon, one of the 2 afternoons. So something to look at there. And the other one is new AI tools really dramatically impacting the workforce as well. So the beverage curve would classically tell us as new hires and job openings come down, the risk of unemployment should technically go up, and we're not quite seeing that big spike yet. It's unfortunate that Thinkorswim does not want to cooperate with my updated little pull down there, because what I wanted to show you as well, if my eyes could focus for a second, where is it? It's literally where my cursor is. Let's see if we can detach this for a second. There we go. This grid right here is showing us the Fed funds rate in the top pane. This is PCE, so inflation, in the middle pane, and the unemployment rate in the bottom pane. Let me go ahead and zoom in on, we've got to zoom in on which one here. We've got to zoom in on these 2 rather, to make them align. What I want is the green lines to roughly align with each other, just so I can show you the data point of the only time the Fed started cutting rates and things were seemingly fine. I think it's easier to do like that. There we go. So these green lines are the early 90s, all right, mid 90s. What I want to point out here is that the Fed was cutting interest rates here into a declining unemployment rate, so better labor situation, declining inflation, right? So trying to spur growth. And you certainly got that into the dot-com boom here before things sort of, the bubble popped and oh my goodness, that's where your unemployment rate gets out of control. Now, notice that we're not cutting into a declining unemployment rate. We're cutting into a rising unemployment rate. So hypothetically, this is not one of the situations that would align with the green line where the market tended to fare well, right? The next sort of thing I could show you here is if we just go to the Fed funds rate versus the SPX, and I'll zoom in on this one so the green lines align. There we go. The red lines represent when the Fed cuts. This is when we cut into a decreasing unemployment rate, so stable labor. This is not the situation, not the situation, not the situation, right? Not the situation happening over here. So just making note that it doesn't have to be, and I'm not trying to be a big pessimist, like, oh my God, it's got to be like .com or the Great Financial Crisis. I'm not trying to suggest that at all. But, could it be something like this? Could it be something like this? Right? A little bit more mild. We don't have to lose 50% of the index value, but could we see a little bit of, should the labor market continue to get worse? Should we see that? I mean, it's not out of the picture. Now, once again, I would maintain the stance, and you guys know every single monthly close we check in on this. The monthly trend needs to change to down before really bad things happen in the market, and we're not even close to that. We just talked about hourly uptrends, daily uptrends, weekly uptrends, just talking about the fundamental picture and what you might hear online relative to the conversation around rate cuts, the labor market, and what's going on with the underpinnings of the market. Let's get back on over to some more fundamental data, namely earnings. Earnings actually have been revised in the upward direction through calendar year 25 and 26. You can see these big upticks happening right about in here, and that is going to justify the elevated price point of the S&P, especially noting, if you recall back from last quarter, the estimates for Q2 were actually another downtick on EPS here. So the fact that this has risen so much and we're continuing to get sustained upticks on EPS, the estimates at least, that is bullish for the underlying index itself, because what you'll see as well is that the PE multiple has really not expanded at all. It's not like this has really skyrocketed and the value of the index has only increased because of the prospect of lower rates. That's not really what we're dealing with. We're dealing with a market that is consistently getting higher earnings. Now, a mass layoff situation might impact corporate earnings, but we're not there yet. And I would also argue that, namely your companies, excuse me, like the NVIDIAs, the big Mag 7s of the world, your mom and pop shopping there is not who is going to influence corporate earnings of NVIDIA or Microsoft, for example. So just something to think about on that front. I don't think the situation on the fundamental front is as bad as perhaps it's being made out to be. If we take a look at the earnings calendar for the coming week's worth of trade, we have Oracle, probably interesting from an AI perspective. That's really it. Maybe Rubrik. Rubrik's been an interesting trader recently. We can watch that on Tuesday after the close. Other than that, Adobe might be interesting on Thursday. We got Figma earnings last week. Didn't really go as planned in terms of its IPO continuing to be strong. Big gap down on Figma. So we'll see if Adobe has anything to say about that on Thursday after the close. Let's get back on over to the platform here. I'm going to have to unfortunately stay in this little window here for a little bit. Where do we want to go? We want to go to the bond relationships. This is an interesting conversation because it aligns with a little bit more of the fundamental take here. If we are going to see a large uptick in unemployment and generally deterioration of the fundamental perspective, this is starting to say okay, hang on a second, we were concerned about inflation, and I think rightfully so, right, with the uncertainties around tariffs, but now noting how weak the labor market is, you're probably dealing with massive deflation, right? And that sort of that has been sped up via the revisions of the prior data. The fact that the prior data is not as strong as it once was is okay, hang on a second. Instead of being able to work through some of these higher prices and, people do technically still have jobs, that's, with the prior picture, the revisions are suggesting, no, it's much worse than that. People won't have money to spend. Pricing power is going to evaporate, and the only way to get rid of inventory is to lower prices, right? So that's what this chart is suggesting via this failed breakout in this little circle that we've just highlighted here. And primarily the acceleration to the downside comes on that Friday release. So am I going to be as persistent on the inflation narrative now that this chart has actually changed? The answer is no, right? This is a little bit more deflationary than inflationary. So continuing to watch the breakout point. It's not like we're just going to throw the argument out the window, but that is a interesting and nuanced data point to at least acknowledge. Let's jump into credit spreads. This is eventually rolling over. Again, we try to give this the benefit of the doubt when it diverges from the underlying here. So far, so good. Still bullish on credit spreads there. Let's take a look at junk in isolation. Equal high being made at the all-time high on Friday. Looks great here. Huge new high out of the LQD, which is corporate grade, investment grade. Or investment grade corporate bonds. There we go. That's the proper term. that is still risk on, right? Risk on here out of the bond market, junk, and corporate credit. This is what we just clicked on. We already looked at Bitcoin. We want to look at Breath. There we go. Breath saw a small, mild downtick out of the 200 SMA, but sideways on the 50 SMA, uptick on new highs versus lows. And I think what this starts to illustrate for us, especially if we go to the RSP, is that it really wasn't all that bad on Friday, right? You could see here, clean higher low, still in this balance range. No lower low is probably the most important takeaway. If we jump into the QQQE, you could see a similar picture here where there's no lower low, even though the NASDAQ had that big fade of the gap on Friday. We actually closed over the top end of that Thursday session. So Breath didn't really deteriorate. It was more so just that obviously Broadcom, AMD, NVIDIA as a big culprit, Microsoft as well, and the OpenAI story that's developing there. Especially with Broadcom, basically. Robinhood, these names were really what was weighing on the market, not so much broadly speaking, all of the cohort. Let's take a look through volatility here. Looks fine. No big spike in vol. As a matter of fact, it's actually coming down from a spike in volatility. If we look at the VVIX, we'll see a similar picture coming down here. And if we look at the nuanced picture of volatility through the different terms, you could see we are still in backward contango here, excuse me. That's bullish. This is still in contango as well. And we're comfortable out of the one-day VIX also, noting that after the labor report, this kind of crushed, and that likely led to a lot of the gap up in the pre-market session coming from this elevated read pre-market to an open down here. With that, I think we could take a look through the core list of companies. We can close that down for now, give this a little reset on this side, and let's jump into NVIDIA. Let's get the job done. You can clearly see here a breakdown from this balance range here on Friday via the gap down. AVGO, a direct competitor now, basically taking market share from NVIDIA, massive $10 billion customer. It was the mystery customer later revealed as OpenAI. NVIDIA moving lower on that news, of course, making a new low. We are officially in an NVIDIA daily downtrend via a lower high here, and undoubtedly lower lows happening here. So the name of the game is to change tone to being a little bit more bearish. It's still been very interesting on this breakdown. Really, unless you were short on this day here, it has not been very lucrative to be short intraday. You really have to be picking your spots very carefully. This balance range did not yield a multi-day high breakout, and instead now, if this acts as overhead supply, staying under 168 is bearish consolidation, ultimately seeking this gap close over time. 161.20, 160.20 is the gap close below. This previous breakout point at 158 would be your next target. Let's take a look at the hourly and see if there's an actual trade setup for this. Unfortunately, there really isn't. The only thing I could see here is a rally that rejects 168, some sort of bearish inverted hammer here. Maybe the risk reward sets up something like this for a target down at 163.75. Other than that, I wouldn't want to just randomly be short inside of that Friday range. If we were to recapture and do something that looks like this, perhaps gap fill reversal daily 50 SMA retest rejection would be the next short location for a daily lower high to persist in the trend count. So kind of taking NVIDIA day by day at this point, it's been a very, it has not been a good trader, right? It has sort of fallen out of favor ever since this consolidation back here had started pre-earnings. It's not been a great trader, and for that reason, I'm just not going to force the issue. Let's take a look at Microsoft, and let's see what's going on here. Big bearish engulfer on the Friday session. Once again, the OpenAI story and sort of what's going on over there. OpenAI seemingly getting ready for an IPO at some point, given some of the moves that they're making, focusing on their own chips now. Very interesting story with AVGO, Broadcom. So you can see the lower high here off of that 511.25. Before the breakdown on Friday, I think it made a little bit more sense seeking some sort of break through that to set the lower high here. The retest of the breakdown point didn't happen, and you can clearly see the close underneath what is just bear flag consolidation lows at this point. So any consolidation below 498.75 keeps the bears in play here, and what I'd like to see is rally retest rejections. So counter trend here, hourly lower high, underneath those equal lows, set the risk reward here, and then retarget 490. That would just be straight up daily trend continuation of the bear flag breakdown. If Microsoft is going to take the momentum here from the breakdown and offer continued downside, under 490, 480.50 becomes your next target. Let's take a look at Apple and see what's going on with the daily chart first. Relative strength to the broad market. Here's your bull flag breaking out on the Google news from that what would have been Tuesday into Wednesday overnight. You could see that any pullbacks sustaining holds over 236 are bullish, seeking upside continuation in the upward direction. The major target 247.25. Beyond that 253.25, please have some respect for 242.50. That is, if we go back here, the sort of rejection points prior to this breakdown, okay? If we look at the hourly time scale, You're definitely in a grinding uptrend here. I think a lot of the market momentum has played out from the Google news, of course, so I might take it a little easy on the long side. I would not maintain as bullish of a stance as what we had on the gap up day, but undoubtedly still in an uptrend, still seeking continuation of the upside, so long as we're over, really, the gap, right, which is the top end of the previous daily pivot from back here at 234.25. Let's take a look at Nancy on the daily time scale first. Getting out of this midpoint cluster range. So if this is the pivot high, this is the pivot low, you sort of had range compression going on in here. Finally breaking out on Thursday. Pullback on Friday was a little bit harsher than what you'd ideally like to see. There was an intraday hold there, but we could not wick off of it for the daily close. 232.50 is still the key spot. If we could stay over it, I would consider this bull flag consolidation. Next big trade would just be over 236.25 on a daily Brigade bolt, hourly Brigade bolt, targeting the all-time highs at 241.15. Here it is on the hourly chart. Once again, you saw a little bit of an initial reaction off of that 232.50. Would have been better if the daily close could have wound up somewhere here, then offered a day trade or some kind of setup early in the week for something that looked like this over 236.25. For now, I think the watch will just be, can this turn into maybe inverted head and shoulders to long it off of 232.50 back to the high? That's one interesting situation. If it does fall into the gap, I would be willing to short Amazon under 230.75 to target 227, just noting again that it would be a failure of the daily pattern here. Back inside the balance range into the gap, I probably think mean reversion is a reasonable outcome. So that is Amazon's downside. Let's look at Google. Big strength in the gap up here, the antitrust ruling. No longer going to have to spin off some of that Chrome. You could see any consolidation over the high of that Wednesday gap up. All set, 230.75, bulls on parade, blue sky territories over 235. There's really nothing concrete or complicated, I should say, to talk about on Google. The only thing you might say here is that if you drop this level, which is technically going to be at 233.15, let me just make this dim and gray for a second. If you drop that, hypothetically, this rally could be retraced. I would still have some respect for this 230.75, but any sort of, start to consider this little bit of a short, very, very short-term head and shoulders under that neckline could have a quick scalp, about 3 points, give or take, a little less than 3 points, obviously, down towards 230.75. Monitor for continuation here if you'd like, but it also wouldn't be unreasonable that this pullback then just yields that, right? Huge relative strength in Google. Shorting this, I think you have to be very, very careful on the short side. Let's jump on over to the metaverse, and let's start with our daily time scale. Kind of an interesting two-day balance occurring here Thursday and Friday. Thursday, really strong rejection of that daily 20 and unable to really hold consolidation over 756. So on the Friday session, the fact that we're not breaking into the gap, though, it doesn't really seem like sellers are responding off of that initial reaction from the daily 20. So to me, leaves a little bit to be desired here. If we go on down to the hourly chart, you can just see the strength of the sellers in those upper wicks. But once again, not able to capitalize on that momentum to close the gap there into that Wednesday high. A little bit of a head scratcher in terms of who's in control. So I would simply treat it as a balance range. Would really need to see consolidation here, Brigade bolt over Thursday's high, that's 761.25. Then structure retracement should likely bring us 769.75. If we do break to the downside, I would sort of maintain a little bit more of a bearish stance, noting that the daily chart is actually in a downtrend, right? Highs, lower highs, noting that there's just been no daily close back over the 20, trying to find its way likely back down towards some sort of equal low. We'll see. Again, trying to give the sellers a little bit of the benefit of the doubt there. We would also be back down underneath. If I just zoom out a little bit, there we go, not that much, this previous all-time high, right? 745.50, which is the top of the gap, which is the bottom of the two-day range. Let's take a look at Tesla. On the daily time scale, the balance range is kind of bothersome, but you could also say that we're trying to build an upward channel here. I think the story on Tesla is the weekly, honestly, which is not really helpful as day trade, but or shorter time frame trade. But this needs to do something. It's got to either do this and then fine, we'll start targeting these highs back here, or if it does this, then fine, we'll target these lows from back here. But really, just inside of this balance range, you're not. There's always opportunity on Tesla if you can be patient enough to spot it and find it and actually execute on it. But the better and cleaner trades will absolutely come from clearing the weekly range at this point, in my opinion. Going back down to the daily, gap and go on that Friday session, unable to really fill that gap underneath the previous pivot from back over here. So consolidation that persists over 347.25 would put the pressure on the top end of the weekly balance range. We'll see if we can get there. If we take a look at the hourly chart once again, the upper wick, they're pretty nasty on Tesla's hourly, but no follow through to really close the gap more substantially and a close back over 347.25. So consolidation here once again, This would be the outcome early on in the week, over 356. Can we get risk reward like this up towards that 365? That's the primary idea I would look for. If it is going to fade the gap, you're just back in the middle of an even sloppier subdivision of that daily balance. I wouldn't love it inside that range. Let's go on over to JP Morgan. Big reversal out of financials, as we've already described. It's kind of right at the key hold spot. It's either do or die on the Monday session. We hold above, fine. Bulls are still in control, and you're building out a new stair step in the upward direction. If you fail it and you consolidate in here, the bears open the door to a huge reversal underneath 288.25, bottom end of this balance range. Watching that very closely out of JPM. Let's continue along to Palantir, just failing marvelously from the sellers. Let's go to the hourly chart so you can see this. Look at this balance range. We've been tracking this for weeks now at this point, as long as it's been in play. Again, think about the exercise we did on Wednesday. What do the sellers want to see as a bare minimum outcome headed into the end of Friday? We broke the balance, we broke the key level. All we need to do is set a lower high underneath 152.50. Just didn't happen. So any consolidation that's back in here is technically a look below and fail. Holds of 152.50 should target the opposing end of balance at 162.25. I don't know that that's the cleanest trade considering how choppy this balance range is. Might take a little while to get there. I would certainly respect 158.15, but that is ultimately how I would trade it, right? Look below, fail, holds over 152.50, stop just below, entry somewhere in here, risk, reward, top end of the range is the target. Great, fantastic, we have something to do. If we just break through the top end of the range, this is still a much more attractive spot to be trading Palantir. Let's say that early on in the week, let's say Monday morning, we open on a move underneath 152.50, let the bears have their time to shine, let the lower high persist, target equal low 144.75, and on the daily chart, right, you're starting to get a bear flag breakdown. Should you get back down underneath 152.50, please respect that for what it's worth. You're underneath the daily 50, underneath the daily 20. Bears are making a stand here, right? Let's continue along to Broadcom. Broadcom, huge gap on earnings. This is one of those charts where there's not really anything to do until better structure builds out. You have an intraday level at 340.50, so consolidation in here, it's bearish. Maybe some sort of fade of the gap like this. If we pop that level, let's just go to the hourly chart so you can see it. If you pop that level at 340.50, right, you could argue hourly double bottom over the neckline. Great, we squeeze shorts up to the all-time high. If you just consolidate in it, it's a bear flag. Fine, this to fade some of the gap. So keep it simple, 340.50, 331.30. If we open on a move in the gap, I would say gap fill reversal to target previous all-time high. 317.25 would be a reasonable outcome. Next up, AMD. Daily timescale has completed its actual breakdown as of Friday. Through the equal lows, you have highs, equal-ish highs, maybe even call it a higher high. This undoubtedly is a lower high, so you could start to draw out, descending triangle. You could call this, head and shoulders, whatever you want to call it. We finally broke down on Friday through the key lows in here at 158.50, so the downtrend is officially in play. Now we could see lower highs under 158.50. We could see continuation to close the gap. We could see continuation down here to retest this thin structure, which is closer to 142.75, 139.75. On the hourly time scale, you can see just like Broadcom, it has a bear flag on the intraday, but this is not after a gap up to new all-time highs. So if you want shorts, I would probably focus on AMD. I would not try to focus on Broadcom making a brand new all-time high. So bear flag consolidation and breaks, we just talked about the gap close. Even if we do rally here, you could play for the squeeze out of the flag, but still, when and if we retest 158.50, that's where I'd be seeking lower highs for risk reward like this to close the gap over time. Once again, that's 147.60. Let's take a look at Robinhood and see what we've got out of this name. Your head and shoulders is absolutely still in play, but it's in play. It has not officially triggered. We've not really seen price acceptance underneath 97.75. Robinhood is going to be included in the S&P 500, and it looks like after hours. That was announced on Friday after hours. Right now, the after hours price is 107.31 by 36, opening right around in here, daily 20, towards the highs of that Friday session. We'll see ultimately where we open up on Monday morning. Notice that is still, technically speaking, a lower high in the daily trend count. So I wouldn't jump for joy. I would not just buy this because, heck, it's going to be included in the S&P. I think that's mostly priced in at this point, and if you sustain a downtrend, break of this neckline, 97.75 is more meaningful. So once again, let's just assume an open somewhere here. You saw the aggressive breakdown on Friday. If you reject that daily 20, I don't think anything has really changed, right? It's going to require a concrete trend reversal if we're going to move this chart back in the upward direction, and we just don't have evidence of that yet. say that this is maybe going to turn into double bottom, I would like to see at bare minimum acceptance over 107.50 daily 20 for me to change my stance on Robinhood. With that, let's take a look into these 3 additional trade ideas. Let's start with something loosely related, Coinbase, just because, of course, exchange, retail, whole 9 yards. You get your sort of bear flag, if you want to consider it from this perspective, on the weekly, descending triangle, balance range, whatever you want to call it. I think the most attractive part about this setup is the thin structure that exists from back here. Remember, that's on the Genius Act being passed earlier on in the summer. If you're going to retrace that move, which I still think is reasonable, underneath 294.50, you've got room to fall into 269. Here it is on the hourly time scale. Let's just zoom in on this first. Again, no structure in that straight up move. If we look now to the right, we don't need to be this zoomed in now. Let's do this. There we go. You can see that on the Friday session, a little bit of a bear flag break is already starting to happen underneath $300.50, the very obvious area of support from all of these prior interactions. So if $300.50 can continue to act as resistance, and if we can actually Brigade bolt under 294.50, there is some room here to the downside on Coinbase. That would be a very interesting short, especially if Bitcoin remains weak over the weekend and does not recapture its neckline. Okay, so that's Coinbase on the short side. Let's jump on into IBM. Let's keep it tech related first, and then we'll of course go on over to UNH and do a rehashing of that chart. That'll be your 3 ideas. We'll wrap it up on that note. Here we go on IBM. Notice the daily change in tone via the higher low happening here. A little bit of a pullback, sustained a higher low, and now we're trading over the neckline of what could be considered very loose and ugly double bottom from this point of view. What I find most compelling is just the fact that the daily candle is an inside hammer on that Friday session, not a large breakdown candle like what we saw over in the S&P or the NASDAQ. You can see it's also the origin of the breakdown from back here and the daily 200. So all of a sudden we have all of these things for confluence at 248.75. If IBM can break the inside candle high and offer an intraday Brigade bolt, I think we have risk reward along these lines targeting 254.75. Here it is on the hourly chart. We would recognize this as just a very simple bull flag. If we break out through the inside candle high, again, there you go. There's really not much here off to our left. Looking at the thin structure through the breakdown, really just targeting that high here at, again, 254.75. So that's it. That is IBM in a nutshell, looking for some upside out of the bullish 3-bar play, given the daily hammer on Friday. Then the final idea, again, UNH, sticking on the topic of healthcare and that XLV chart consolidating above the gap. Notice that this is starting to break through the highs of the range on Friday at 313.65. If you take a look at the hourly chart, nice little consolidation there into the close here as a potential little hourly bull flag. If you can break this flag, if you can get something going in the upward direction, really talking about 336 on the upside as a potential pivot high. What else could possibly be in the way there? Let me just make sure on the hourly chart. Let's do this together real quick. What would the level be from back over here? You have this, and you honestly have this as well. If you wanted a little bit more confidence, you could say you want to break that pivot high from there. Just call that 225.50. 225.50 could be your confidence-inspiring level if you are seeking a little bit more of a, I guess just that, confident look, noting that this gap above would definitely open the door for better risk reward should we start to move into it. All right, so that is UNH starting to break the range. A range double brings us to the bottom end of the gap, and if we could stay over 325.50, the gap overhead becomes a reasonable target up towards 377. That's what I've got for you in today's episode of the Weekend Update, the weekly watch list, if you will. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live, as we typically are, every morning at 8 o'clock Eastern Time here on the channel for another episode of the Pre-Market Prep. We do have inflation data coming up next week. I sort of, in the flurry of talking about the labor situation, forgot to look forward here on the calendar. We do have PPI as well as CPI based on the way that services prices paid came in. This is actually a little bit of a downtick on prices paid. Not bad, but generally speaking, I would not be shocked to see an elevated print still out of the CPI here. It looks like we're still looking at a 2.9 on the year over year, which again is very far off of the Fed's 2% target. The only thing that sort of is in the back pocket for the Fed is if labor gets out of control, that will be a deflationary impulse for the market because nobody will have any money to spend. The only way to get rid of inventory is to bring prices down. Okay, so there is your quick look going forward into the economic calendar for this week. Again, we will be live every morning at 8 o'clock, so we'll cover it live on the channel here anyways when those numbers are released on, I think it was, Wednesday and Thursday respectively. They flipped them. Yeah, PPI ahead of CPI this week. Usually it's the other way around. Hate when they do that, but it is what it is. So we'll see you back here on Monday morning, 8 o'clock. Enjoy your weekends. Hit the thumbs up button, subscribe, all that stuff YouTube tells us to do. What else? There's resources in the description. Have a green trading week. And as always, I will see you in the next one.